Welcome to Beyond Wall Street, presented by Arixa Capital, where expert investors make their unique investment strategies easy to understand. I'm your host, Jan Brzeski, and today I'm with Jerry Ducot, co-founder of Lone Oak Fund. We'll be discussing commercial real estate bridge lending in California. Jerry, it's great to see you as usual. I've known you for a long time. I think meeting you about 10 years ago, or maybe a little longer ago, was influential for me because it kind of opened my eyes to the opportunities in areas related to what you do. So I really appreciate that, and appreciate your being on the interview series today. So let's start with your background, and just if you could maybe spend a minute or so with your background before you started Lone Oak Fund, what you did in your career. You've had a very interesting career, and then we'll get into Lone Oak after that.
Well, I've been in real estate all my life. First in property management, then as a developer small buildings, and then I was building medical buildings, and then from there I probably morphed into Lone Oak in the early 2000s.
Tell us how and why you started Lone Oak.
Well, my partner actually had been making individual loans, and he'd always wanted to start a fund. And he and I and another were building houses, and which was not something I was terribly interested in. So he asked me if I'd like to start a fund, and I said yes. And so that was in 2002. And so we formed the fund. And we made our first loan in 2003 of about $400,000. And from there, we continued to grow. We raised, we were an LLC initially, and then we morphed into an REIT, which is what we are today. Okay,
great. And we'll get into that in a minute, but let's start out with what kinds of investments does Lone Oak Fund make? Can you give an example of kind of the range of investments that you make today?
Well, post-COVID, we're a little more restrictive than we were pre-COVID. So today, our focus is on apartments, single-family homes, non-owner occupied, a lot of upscale single-family homes. And industrial. We also do land loans, urban infill land. And we're also now, for the first time, starting to take a look at shopping centers. We're actually getting ready to fund a corner neighborhood shopping center, which will be a first for us in some while.
What kind of rate do the borrowers pay, and what kinds of fees do they typically pay for the loans that they get from your company?
Right now, they're 5.9 and 6.9. 5.9 for over $10 million, 6.9 for 1 to 10, 7.9 under $1 million. We typically charge a point for the larger loans for 12 months, 1.5 for smaller loans.
So the loan term is about a year, or does it sometimes extend longer?
Well, typically, but we will go up to 2 years.
I think a lot of people that are going to see this interview series, they're investors that are looking for other options besides stocks and bonds, and they may ask, why don't these borrowers just go to a bank? Rates are so low right now. You know, bank loans on houses can be in the 3% range. So why is it that borrowers find Lone Oak's loans so valuable? Borrowers or brokers, and maybe you could explain that.
Well, brokers, of course, love us because we're quick and we protect them. There's a variety of reasons. For instance, if it's an apartment building and it doesn't have a certificate of occupancy because it's only 90% completed or less than 100%, we will make a loan on that, whereas the permanent lenders will not until they have the certificate of occupancy. So what happens a lot of times is a construction loan, and the borrower, his loan comes due. The lender calls the loan. Lenders want to get paid off, and so we step in and we provide interim financing. So that's one reason. Sometimes it's a matter of time. We've had loans that they're in escrow. They need to close. They may have been talking to banks. The banks aren't really providing them with speed, and so they come to us, and we can close. We've closed loan. Well, we closed one loan in 6 hours, so we're very fast. Sometimes the borrower just doesn't want to deal with the peskiness of going through an institutional lender. And so, there's a variety of, sometimes the borrower's credit's not good. We're an asset lender, so we don't take that. We look at the credit, but not carefully. It's not, so sometimes someone will inherit a property, for example, and they have a very low FICO score, but it's a nice little apartment building located in a nice area. We'll make that loan.
And you mentioned that you're an asset-based lender, so you must always make sure that there's a big difference, a margin of safety for you as a lender. Can you talk about that? How do you decide how much to lend on a given asset?
Well, we pretty much limit ourselves to 60% of value, or purchase price, whichever is less, for the most part. Once in a while, we'll go to 65% if someone got an unusual buy and it's an apartment. A lot of our loans have junior financing behind them, which comes in with 10 or 15%, sometimes even 20%. And so we're able to, we make our loans. Somebody buys a property for $1 million, we lend them $600,000. A junior comes in and lends $150,000 to $200,000, and so the borrower gets his money that he wants, and he gets a blended rate, which is probably pretty competitive. And so we sell the blended rate.
We talked about brokers before. I was referring to mortgage brokers. I think when most people hear brokers, they're probably thinking of a realtor. But can you explain what mortgage brokers are and what their role is in our industry? And I think that would be valuable to a lot of people, because I know Lone Oak, if you go to your website, it talks about the broker's lender, or at least it did at one point. And I think
that's our client.
That's a good distinction for people to understand. Can you explain what mortgage brokers are and how it works?
Well, mortgage brokers arrange for financing. Sales brokers arrange for sales, and our leasing brokers arrange for leasing. And frequently, sales and leasing brokers could be one and the same, but mortgage brokers are typically, that's all they do, is arrange for loans. And our clients are the mortgage brokers, not the borrowers, but the mortgage brokers.
Got it. Let's change directions a little bit. You talked about being structured as a REIT. Can you just briefly explain what REIT stands for and what it means, and why you chose to do that?
REIT stands for Real Estate Investment Trust. And we chose to do that. For one, we don't have to issue a K-1. We now issue a 1099, which is much more efficient. Two, the top 20% of our distribution to investors is not taxable. So, for example, if we distribute $1,000 to an investor, the investor only needs to report $800 for tax purposes.
Okay. Let's talk about your decision to not use any structural leverage or bank financing in your vehicles. In the area of non-bank lending, there are some funds that have no structural leverage and others that do. And can you explain what that is and how you chose not to do that?
Well, it starts with a personal practice of not having debt, or as little as possible. And so by not having leverage, we're less vulnerable to the vicissitudes of the marketplace. And we're also not dependent upon a bank uh, providing us credit, not providing us credit, second guessing our underwriting. So it's cleaner. And we cater to an investor who likes safety. So when you invest in Lone Oak Fund, you're investing in a company that has very little risk relative to a leverage fund. And but our yields are less because we're not leveraging. And so that's the trade-off. So by doing this, we're able to weather storms, and our investors are satisfied with our yields, which are now down to about 6%, because that's where the market is.
You've been doing this a long time. I think many of the people that make non-bank real estate loans got going after the great financial crisis. You started doing this well before the financial crisis. So I'm very interested in your perspective on what you think the next several years will bring for our industry.
I think the competition is getting more sophisticated. When we came into this industry, it was kind of a mom and pop, and you had a couple of large hard money lenders, and they were kind of hard money lender kind personalities. And I say that today the lenders are more sophisticated. They're making more sophisticated loans, and there's a big market for making loans on small single family loans, houses, which is not our market really. And But I think the sophistication is changing, and this is pushing the yields down. You know, if in bonds they can only get very low interest rates, if they can make 6% in mortgage lending, they're going to do that. And then with leverage, that goes even higher.
Very good. So Jerry, I know you're a substantial investor in your own fund. Can you explain what you like about your fund from an investor's perspective? What's something you really that appeals to you?
Oh, yeah. I mean, I know when we first started, we put in $1 million. We put that into the PPM that we put in $1 million, and it took a while before, speaking for myself, that I began to gain confidence in what we were doing. And fast forward today, we now have probably 250 or 300 loans spread over $1.2 billion in loans, and so and we're diversified. We're primarily coastal county from San Francisco down to San Diego. So I like the diversification. Our average loan is probably 0.3% of the total portfolio. So we're very diversified. We have 60%, between 50 and 60% is our loan to value. And so it's very safe. So today, my partner and I have over $100 million in the fund because it feels safe.
Let's talk about the risk. If there were ever to be a loss in your fund on a loan or in a given period of time across the whole fund, what would have to happen? What do you think would be the most likely thing that could cause a loss? And I know that your goal is to
other than California becoming an earthquake after the major earthquake.
I'm including anything and everything that you think is if anything caused a loss. What do you think would be the top one or two things that would actually be the cause of that, if you had to guess?
You know, I'm going to say earthquake is probably the event that concerns people the most, and we're diversified. So if there is an earthquake and we lose one or two buildings, and that includes, you know, a total loss, which doesn't always happen, we're diversified there. So from an earthquake point of view, we feel pretty comfortable. So now if there is a financial earthquake, well, we had one of those in 2009. 2008, 2009, 2010. And we ended up during that period of time, out of our portfolio, I think we had 23 foreclosures. And we ended up selling those properties. We had either a break even, or we got our interest back, or we even had a profit sometimes. But if there is a loss in the fund, the loss dilutes the yield rather than reduces the investor's investment. So instead of the loan, instead of distributing, let's say 6.5%, we might distribute 6.2%. But the investor can always redeem at par. So we've been in business since 2003, and we have honored 100% of all redemptions at par.
So you lend only in California. Can you explain why you made that choice? And I think, has your view changed in any way with COVID, with California? We don't see a major population move out of California, but certainly there are other markets that are more business friendly today and have lower density cities than, say, San Francisco, which we were talking about before. So what about, how did you make that decision to stay in California?
Well, to stay in California, first of all, we understand the California laws, which there are nuances in the laws that you don't know unless you focus on it. When we make a loan in California, it markets itself. If we make a loan in Nebraska, who's going to hear about it? Thirdly, we've learned to know the markets better than ever. I mean, really, we made probably close to 7,000 loans.
You're a bit of a pioneer in this industry, in my view, because you've been doing this a long time. Can you comment on what's happened in this industry since you started Lone Oak Fund in the early 2000s?
Well, when we started, it was a different kind of industry altogether. It was, for lack of a better word, a used car salesman type of industry. The leading brokers were really hard money lenders. And so we were not very popular because we came in with lower rates, a whole different approach. And since then, I think that approach has caught on. So I think there are many more quality lenders making bridge loans like we do now than when we got started. There were very few.
Do you think that trend will continue?
I think so. It's a great place to be.
Well, Jerry, thank you as always for the time, and it's been a pleasure.
Thank you for the opportunity.
I'm Jan Brzeski, and you've been listening to Beyond Wall Street.